Hello and welcome to Options Guide TV. My name is Brian Overby, author of the Options Playbook and your host for today. We're going to be short and sweet. We're at the tail end of earnings. The earnings are always kind of filtering in around. There's nothing too exciting this week. There's always something in the mix, but today I'm going to just concentrate on the S&P 500 index. And do we actually believe that the ceasefire is going to hold? For some reason, it feels a little bit more genuine, I guess. And we're going to ride that. We're going to ride the wave, if you will. And as you know, that if we are putting on a 0 DTE trade in the S&P 500 index, we have to get it executed very quickly. So in this instance, we have the June 15th expiration in the S&P 500 index. And we're going to run to the Trader Pro software. If you have any questions or comments, please do put them in the chat box, but I want to get this order executed as quickly as possible. We see the VIX actually showing some signs of positivity as far as ceasefire is concerned. We got the S&P 500 index up 1.5%. We see the VIX down to 1621. So it's quickly descended from the 20 level, and it's back down around 16.21 right now, down $1.47 on the day, or 9%. And I think that's a good sign for the market. And we had a lot of good feelings in the marketplace after the SpaceX launch. SpaceX is still doing well today, so I think we're gonna lean into this positivity, and we're gonna do an open wing butterfly with calls on the upside in the S&P 500 index. So with the SPX right now trading at $7,549.23, we're gonna go a little bit in the money, and we're gonna buy the 75.30 strike and go at the money and sell 2 of the 75.50 strikes, and then buy 1 of the 75.60 strikes. So that's 20 points wide on the long spread, 10 points wide on the short spread. We're able to get this done for $9.15 at this point in time, $9.25. Really like to be able to get it done for about $9, but I think we'll put it in at $9.25 right now. And we're going to send this down to the trading floor. Boom goes the dynamite. Order has been sent. Okay, so in this instance, we're a little bit late. It's 11:10 right now, a.m. Eastern time. Oh, we already filled on that trade at $9.25. Yeah, I think $9 was the right price, and that's where I'd be trying to fish for it, because here's why. We're going 20 points wide on the long side, and we're going 10 points wide on the short side. So that means the maximum that this could trade for is well, let me say that. Well, the maximum it could trade for is the 20 points from 75.30 to 75.50. That's the maximum width of the spread, and that's the maximum the butterfly could trade for if it went right out at 75.50 at expiration at the end of the day today. Now, on the upside, though, if the market continues to climb and it goes above 75.60, at that point in time, this is worth 20, the long spread is. Short spread would detract 10, and this would be trading for $10. If we fill it for 9 and we run over to the what if calculator, we'd actually be making $1 on this trade above 75.60. Now, if time is just decaying and the market stays somewhere between 75.40 and 75, it doesn't really matter on the upside, 75.40, because that's pretty close to where the break even is at. And it just hangs in this area right now. By 1 or 2 o'clock, we probably take this trade off, and we might get more than 10 for the trade. About 1 o'clock is when gamma and theta kind of have their battle. Theta is still very large time decay because we're selling two $12 options that have a half a day to live. So two $12 options have to go to zero. If the market stays right where it's at, it would be, well, actually $1 in the money. But with that said, all that time premium has to come out. $9.75 of an extrinsic value of time premium has to get removed in that instance. Now, if the market continues on up, we're okay. We're totally okay all the way up. And even if it's trading as high as 57.80, we're all right with the trade, because if it starts drifting back down, we're still safe. If we get the big move to the upside, we just want to make sure that it doesn't go below 75.50, our middle strike in the afternoon. And then you can decide what you want to do with the trade. Now, the wonderful thing about the SPX is that it's a cash settled index. So if you just leave this at the end of the day and you are due some money, there will be cash in your account where there was not cash. And there's no exercise, there's no assignment, there's no chance for early exercise. So with all of this in the SPX zero DTE trades, that's part of the reason why zero DTE has taken off, and in particular in the S&P 500 index. I always like to get these trades on by about 10:30. So with show starts at 11, we had to get this one moving. It's already at 9.50, so you're up 50 cents already on the trade. It's going the right direction. As long as it stays above 75.50, I'm okay with the trade. You just let it ride. And this is what I like better than just the standard butterfly. Standard butterfly would be well, quite a bit cheaper. 20 point, it might not be that much cheaper. Let's see how much cheaper. 7. If we go to 70, it's going to be $3 cheaper. So I guess that's nothing to sneeze at. So here's what a standard, but let's send this one to the what if calculator and we will go look at it in the what if calculator. And then let's go back and send the standard butterfly to the what if calculator. Let's pull this on down and go back to the trading page. Go 57.70. Okay, so now 20 points wide here, 57.30 to 57.50, and then from 57.50 to 57.70, that's 20 points too. So this is a standard butterfly. We knocked the price down by $3, and it's now trading for $6. So if you did this trade by 1 o'clock, we want to be out for sure. We don't have any reprieve if we go up or down. If we go down, it hurts us. If it goes up, it hurts us. We need it to stay right in the middle. It's 20 points wide. That's the maximum it would be. The break even would be 75.36 as opposed to 75.39, where the open wing is at. And the maximum you could make on the trade would be 20 points, the width of the spread, minus 6 or $14. So this is the standard butterfly. And let's send this to the what if calculator. And then we'll compare the two. Now, I always like to open wing because one of the things that you're just trying to do on a zero DTE trade is you're just trying to capture time premium erosion. And butterflies in general well, a lot of people like to do them on the zero DTE trades because of everything that we talked about. No risk of early exercise in the S&P 500 index. It's cash settled. At the end of the day, just cash goes into your account. And if you're correct on your forecast and the stock stays within that range. But if you do it, the only thing I don't like is that you can't root for a side. You can't. The market goes up, you lose too much. If it goes down, you lose. If it goes down, you lose. If it goes down too much, you lose too. So in both instances, you really need to be active on this trade at 1 o'clock. No matter where the market's at, I'm probably going to get out of the trade. You can manage your risk that way if you'd like and try to capture as much time premium erosion. You have a $9 was, well, our option when we looked at it, we'll call it $10 of extrinsic value. by like 1 or 2 o'clock, that will probably, the extrinsic value or the time value will probably get cut in half. It'll be fairly close to that, down to about $5 overall. And then by the end of the day, it's got to be gone. So it just starts steamrolling as far as time decay is concerned, as expiration, as the end of the day approaches, which is the expiration date. Now, here's the long butterfly. That's an open wing butterfly. And so from here on up, we can actually make $1. So there's no risk at all. So if we wake up and the market's at 8,000, there's no reason to get out of the trade. You know you're going to make at least $1. And if it comes back within the range, well, we might end up making or being able to close this thing for $20, which means we'd be up $11 on the trade. So in this instance, if the market starts going this way, there's no concern. We still got the concern on the downside. And to have that benefit, we had to pay an extra $3 on the trade. Now, would have been a little bit cheaper if we could have got it done at 10:30 or so, but the show starts at 11. So with that mentioned, I like the open wing butterfly in the SPX. It's one of my favorite trades if I do feel like momentum is going to continue to the upside and we're going to have that bullishness. And today feels a little different. I don't know why. But unless we get blindsided by news, SpaceX euphoria is still going in the market. We see Google up 3% today, which we actually got long Google calls on our Fundamental Friday show. And part of the reason why is that Google actually owns 6% of SpaceX. So to ride along with the SpaceX momentum, we went long some calls in Google, and that's in our portfolio right now. So we have our long position from a while back, and we did one of the, what was this? Okay, the 340s, and we put that together on our show. But then on Friday, we went in and put in the 350s. That's up 14%. P&L is up $517 since Friday afternoon when we put in the trade. Midpoint is $40. Cost was $34.85, and we just paid the ask for it. Interesting enough. Now on this Google trade, we are down 30% on that. That is the 340s. That was an 80 delta trade. We're 95 days away, so we want to decide what we want to. Well, let me see. Markets at Google is trading right now at 371, and we're still really good on that trade. We got 90 days left. We're going to let that one ride, and that's our position right now in Google. Nvidia is also going right along with it. It's kind of a revive of the semiconductor stocks and the semiconductor trades. So Nvidia right now, we got the 215 calls, and oh, that's right. We did in Nvidia, we looked at buying a just in the money call versus buying 3 out of the money calls. Nvidia with the 215, so the stock was right around 220 at the time. Where is Nvidia right now? It is trading at 211. Okay, so it's below both of those strikes, but the stock is strong today. Pretty sure we're up a little bit, a few percent. And 2.84%, up $6. We have 17 days in this one and 67 days in that one. This trade we would have to move on if we're going to be looking at that. We'll close that out probably on Fundamental Friday. This Friday is going to be a holiday, actually. Markets are going to be closed this Friday because of Juneteenth. So that's where we're at with NVIDIA. Our Netflix trade, that's still hanging out. On Netflix, it's at 81. Not much going on there. Apple trade is very strong. Oracle. So Oracle, we got a short put in Oracle. Uh, 230, 265, 27. Oh, we still got some days left in this one until that expiration on the 18th, which is Thursday, because there's a Friday because the markets are closed on Friday. 260. I don't think we're going to get back to that. We went 230, 260, 275. So we did this open wing. Thing is there's an adjustment we could do on Oracle. Let me look and see. The Thursday thing might hurt us, though. So the position, we're 5 points wide here. If we there's nothing left. There's nothing left. So the adjustment that you can look at, and we might have looked at it on Friday if we had the position on, we got 3 extra days remaining, is you sell the 230 and you buy an extra one of the 275s and you roll into 2 short call spreads. So you sell the most expensive one and try to capture as much premium as you can. Right now it's only a dime, so I think we just let it ride. We don't worry about it here. And then you buy the least expensive one. So you're doing it for a net credit to the account, but it's got to be worth doing because you're going to be adding 15 points of risk in the short spread. You already have some risk, but now it's going to be 15 points and you're going to have it on twice, a 2x2 trade. That might have worked out on Friday, but we need a little bit more of a pop in Oracle. But that is the adjustment to the trade. And Oracle's trying to claw its way back. Had a real solid earnings report and then said CapEx spend. And they said they're going to spend more than was anticipated on CapEx. So they're doubling down on their position. They are building data centers, though. They have started. But the stock is bounced today, up 5.7%. So, yeah, everything's feeling kind of rosy in the marketplace. SPX. Let's show that our order has been filled. We filled at 925. I think 9 would have been the price I would have put that order in at. But we're at 9 and 1 by 2 by 1. 75.30, 75.50. That looks solid. Limit 925. That's going to be inside our portfolio now. SPX. And let's see where we end up at. And then we'll just call it a day today. Come on. $9.25. We filled all of those. Yeah, 57, 58, 69. So it's up a little bit more at 127. We do not want it to go back below 58. We're going to leave this in for at least an hour. And if it's hanging pretty close to the 57.50 strike in this instance, if it's hanging very close to that strike, then we want to get out of it. If it drifts a little bit higher, then it's up to you, but you got to watch this trade. If you put it on, you're not leaving to go golfing in the afternoon on Monday. So if it's at 75.50, and it's drifting towards the 75.60 level. If it comes back down to that range, we don't want it to go much below 75.45. Our break even on the downside is 75.30 plus the net debit of 925, or 75.39.25. Now, that was the paper trading fill. If you got a better fill, the markets are way better, and the SPX is very liquid in the real marketplace, even though bid-ask spreads can sometimes look a little wide because you have a very high value index. Usually can get fills, especially on butterflies, fairly close to the midpoint. Especially when you're trying to execute just to get in, you can work the order pretty good. Okay, so that's where we're at. I think we're going to leave it there. We'll come back on Wednesday and we'll take a peek at how the SPX trade worked out. Inside the portfolio, I don't think we're going to change too much up. We got Netflix still hanging out. Apple trade, well, that's from Fundamental Friday. CME trade, we'll probably adjust that trade. We need to do something with CME. We're down, it's at 270. We got 95 days remaining. We're 267. Yeah. Let's close this position right now, and we'll decide if we want to do something with that trade. We'll close at mid. And let's send that order to the floor. Okay, so now we have that order sell to close. Our rule on our deep in the money options is that if the market comes down, and it shows it right here that you have an order, if the market comes down and hits our strike, we want to close it or we want to roll that position. We are down about 50% on the trade, which that's about the right number. If we see it come down and it hits our short strike, we're going to take this position. Now, if we want to get long CME, and we'll look at this on Wednesday, and we still want to trade CME, let's see where that is at actually. It's up 10. Oh, no, it's down on the day. Okay. That's not a good sign. On a big up day like today, the mercantile exchange is down. But we'll execute, we'll get out of the trade, and we'll decide if we want to get long on Wednesday. And if not, we just move on to the next trade. Had some signs here. Probably a decent earnings report. All right, everyone. That's it. That's it. Short and simple this week for this Monday, Options Guide TV. We'll be back on Wednesday, and we'll be looking to check out our SPX trade. We will see if we want to get long the CME again. I don't mind that trade. I think we stick with it. So we'll go further out in time, and we'll find an 80 delta, and we'll own some more CME. It's just something different than a semiconductor stock. And yeah, we'll and then that'll be it. That'll be it for this show. And then we'll come back on Wednesday with another Options Guide TV, and we'll look to continue our CME position. Thanks for stopping in. Talk to you Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.